Hey, day 5, Stock Lecture Tuesday today, guys. We're getting into diversification, we're doing short-term, long-term, and we're clarifying some stuff just to go over in general, some general stock stuff. We'll get into it. Cool stuff. Diversification's huge. Never wanna, we'll talk about it. We'll take it into it. I'm looking at finishing the schedule. The thing for the next week, this Wednesday we're A-okay. Next week everyone's got finals. I've got finals on Tuesday, and then I don't think it's school Wednesday, so might just record them at home and put them up on here. So we might not have a classroom next week. We'll see how that goes. We'll have it figured out by tomorrow, so we'll know by tomorrow. So, yeah. Enjoy, guys. That's very smart.
Thank you. Thank you.
You got it.
Have a great time talking about stocks.
Oh, thanks. It'll be so fun. Have a great one. All right. Diversification day. Let's go. So, here's a bunch of stocks. All right, cool. So we're gonna talk about diversification today, but before we get into that, I totally realized the other day that we haven't talked about stop losses yet, which is so weird because I mention stop losses all the time. So stop losses are pretty simple, all right? Just the Home Depot, whatever, any stock. You'll tell your broker, you'll put in your limit order usually, or market order. You can do stop loss market order, and you'll say to your broker, if you're buying in right now, if the price hits like 5% less than what you paid for it, or if the price goes down to 185 on this stock, I guess, you can tell your broker if it gets to this lower price, instantly sell it. And similarly, you can do a profit taker. So you'll say if it gets to 190 or 195 or something, you can tell your broker to instantly sell it. And you can have it so it sells off the last price. If the last price hits whatever your stop or your profit taker is, then your broker will sell it to the market and you'll get out of the position. So it lets you limit your downside on trades, and it also lets you set your upside. A lot of the time, sometimes people might say, like, if they double a position, then they'll sell half of their stuff so they can retake their initial investment and just play off off their gains will just be what's left in it. Sometimes, or maybe you do like a third, so if it triples, you sell a third of it, and then you have your initial investment back. This is, I like to keep things long term. I like to keep them compounding. I'm not a huge fan of that, but if you want to move your money around, maybe diversify, then you can do that sometimes, depending on like if it's significant enough compared to all the other money you're putting into your account. Two other things we had to talk about: comparing stocks. All right. So we almost got to it the last Wednesday with currencies, but we didn't quite. We got to it in class, but we didn't get to it because like the camera cut off, unfortunately. So let's just get rid of everything on here, and we'll go to the yearly chart on Home Depot. Now there's this great button here called comparison, and what we can do is we can add other stocks and compare how the other stocks or like anything we can find, right? So let's see, Home Depot's retail, Newell Brands does a lot of retail, but then they're also kind of private. How about Lulu? Yeah, they're all athletic stuff. They'll be good. So we can look at and say obviously the different sectors, but you can just do any stock versus any stock, and you can add basically as many of these as you want. You can just keep adding them, and it'll give it as like a percent. So whatever one you were on is for the past year made 20%. Lulu made 107%, and Newell lost you 50%. So it just lets you compare the performance of one stock to another. Where we can see this being really useful is if we go to like an energy sector or any specific sector. Just for example, the energy sector with Duke Energy, we can add Nextra Energy's, the Southern Company, blah blah blah, and compare different stocks, different companies in the energy sector. So maybe we can identify which ones are the best. It's not loading up right now, but you'll just do the add comparison, and then add whatever stocks you want to compare it with. You can do this with technology, you can do this with basically anything. It's especially useful for looking specifically into performers in certain segments and seeing who's the best at them. And I guess the last thing was just currencies. We got through most of it. Just wanted to reiterate before we go into diversification that those are going to be great for short-term trading too. So if we go currencies, and these are going to be the ones where you basically got to be sitting here watching it and making your quick trades, going fast. Actually, here's a good example. So we can see these daily charts on the right side of Yahoo Finance. So you're gonna have to be sitting here looking for these spikes, looking for these drops, looking for the uptrends, looking for the downtrends every day. So when you're trading currencies, it's more active usually. And you can, like stuff like this, I guess you can't really see it, so I'll zoom in on it. This was a daily chart, and we saw, this big spike up, and then this was a fast movement. So these are stuff, it's like it moved from 130.7 to like 130.13. So you're definitely gonna need to take some leverage or put a lot of money in to make it. Well, it's a percent gain like anything else. So the more you put in, obviously, the more you're gonna get out, and the more you're risking. And that's also, percent is how I like to think about things. Rather than saying a trade made $5,000, think of it as a percentage, because like we talked about on day one, right? Percent gain is what dictates how fast your portfolio grows. So it doesn't really help to say, oh, I just made, $1,000. It's a lot different making $1,000 on a $100,000 account and making $1,000 on a $500 account. Like that's huge in one, and the other one it's like, a percent. But the other one's like, doubling your money. You're getting double your money in one trade, so that's huge. So always look at your gains in percentages when you can, and you can compare how well things do based off their percent gains, not specifically how much money they make. Because how much money they make, that doesn't really translate to everybody, but percent gains do translate to everybody. Everybody can multiply whatever their average position size is by, 100 or 1.2, so 20% gain. Okay, so let's talk about diversification. Don't put all your eggs in one basket. I'm sure you all know that. So if we were gonna go and make a list on Yahoo Finance, we could go over to the top, I guess probably the top, and sign in somewhere. Go ahead, sign in. So you create an account with Yahoo Finance, and once you do that, what they'll let you do is make your own list of stocks. So you can go to any stock, and you'll see this little star right here, and you can add it to a watch list of yours. And you gotta sign to that, obviously. I'm not signed in on this, unfortunately. But you can start, and you can put collections of stocks in, star them, see who has the best percent gains, who's making you the most money, and over time start to actually put positions in. And the other great thing with Yahoo Finance, unfortunately, I'm not logged in, but you'll go to your portfolios and you'll start, your watch list with your starred stocks, and you can insert positions. You just go to my positions, and if you make a trade with a broker or someone, then you can put it in here and it'll add it to your position, and it'll give you real time what the price is, what the value of your account is in real market time. So it's just like your broker. If you go through your broker, which we'll talk about later, and you buy a share of Nike, you can tell Yahoo Finance, put this in your watch list, and then say add +1. Today I bought a share of Nike for $71. And then Yahoo Finance will say your account is worth $71, and your broker will say that too. So you can synchronize your broker. There's actually some more settings in Yahoo Finance once you sign in, where it'll say synchronize your broker, so you can actually place trades through Yahoo Finance. As you can see, there's like buy, sell. I don't do that. I don't know how that works. I think they get like a commission or something with fees, but I don't mess with that stuff. I just go straight through brokers, and most of my technical analysis is especially for short-term and swing trading. Well, mostly short-term. Like if you're day trading, like you're not using Yahoo Finance, you're gonna use the trading platform your broker comes with, so that you can really get active news feeds. Like these are not going to be the best news feeds, especially for active trading. You know, if I go to like a penny stock, just I don't know what's today's top gainers. I'm sure there's one on there. These aren't like, this is not the best volume readout. You can see we got some blank candles in here on the 1 minute chart. You're not going to see that with the trading software your brokers are going to give you. Alright, so once you have your account with Yahoo Finance and your broker account, we'll talk about later, you pick your stocks and you're like, alright, great, let's buy some stocks. The important thing to start out with, guys, I think a general rule of thumb, if you can do it with a larger account, because sometimes stocks are expensive, right? So maybe you can't.
Mr. Wyatt, please dial 2402. Mr. Wyatt, 2402.
I think Amazon's like $1,600 right now, but then you know some stocks like AMD are like $12. So obviously, buying a $1,600 stock is in a, you know, say your portfolio is $5,000. That's a pretty big position compared to maybe buying like 10 shares of AMD with like $12. It's $120. So sometimes you might, when you're starting off, have to avoid larger companies, because I think a general rule of thumb is don't let any single stock or equity or any really big fund take up more than like 5 to 7% of your portfolio. This is like conservative average. Try not, like, no matter how much you like it.
Jake Chambers to carpool, please. Jake Chambers to carpool.
5 to 7% is usually a pretty good number. You don't want to have it where, you know, your whole portfolio is a bet on like 3 stocks or something. You want to make sure that the price of one stock isn't going to affect your whole portfolio. The whole portfolio is going to be what determines how successful you are. And you do that by making your picks like 5 to 7%. And if you really like a company, I really liked AMD at, let me pull them up, at like $14 like almost a year ago. And I mean, they just took a huge L. And I had a big position in them because I was just starting off, you know, not as diversified. And they dropped to like $9.90 one day, something like that. I mean, it was like, just because you think that it's going to go up, you can never be 100% with this stuff. And that's why you diversify and don't take positions that are way too big. You always want to make sure your stock positions are gonna, you know, if one stock goes to 0, you're okay with that. Like, that's basically the risk you take with pretty much any investment, is the entire company goes bankrupt. How much of that do you want to affect your whole thing? Now, obviously, you know, most of these companies have been around for, I don't know, I think, when was AMD? You know, they've been around for decades. But just think of it as you don't want one company, one stock to take up too much of your overall portfolio. And a great way to look at this is like the weighting of these index funds. Index funds are kind of the exception to this because they're already diversified in and of themselves. So when you have stocks in those, or if you buy like an ETF, they're usually already diversified, and most of the time they might have like a couple positions that are big, like, you know, maybe I think the QQQ has like a 12% stake in Apple, and then maybe like 8 to 4 to 2 and some other big tech companies that are doing very well, tech giants. But then like probably about 80% of their positions are like weighted around 1%, like less than 1% of the overall portfolio. So it's very diversified, obviously. Oh wait, no, that was not the S&P, that was QQQ, but that's just the NASDAQ 100, but in a weighted fund. And that's by power shares. We talked about that last week. With mutual funds, usually those are going to be like market sector dependent. And another important thing to know, to remember in the back of your head, is to not have your portfolio balanced too much on a single market sector. Like if tech goes down in the next year and a half, you don't want your entire portfolio to go down. Similarly, if electricity goes down, utilities go down, water goes down, you don't want your whole thing to go down. And in corporate America, these big dividend-paying stocks, if all the dividend blue chip stocks, if all those go on a downtrend, you want to have diversified. You want to have other market sectors captured in your in your portfolio. Now here, Yahoo Finance gives a very good list of the industries. You got financial, healthcare, services, utilities, industrial goods, basic materials, conglomerates. That's a tough one to say. Consumer goods and technology. I say that's a pretty good list of all the industry. And you just want to make sure, your entire portfolio isn't just healthcare, or, half your portfolio is conglomerates. I wonder what a conglomerate is. I really do. I've never heard of that. I assume they'd be like medical companies, but that'd be under healthcare. Medical companies, they're always just kind of sketchy. Oh, okay, so like interchangeable parts. So that's a big industry. Yeah, I can definitely see that. So, you don't want to have your entire portfolio balanced around like one industry. You always usually try to spread it out and have different stocks in different industries, and make sure that those individual stocks, usually not more than 5%, 7%, like high of your entire portfolio. Like having one stock is 7% of your portfolio. When you're starting out small and you've got like, $1,000 or $500, or like, if you've just got a little bit of money and you can't diversify to like a 5% standard purely because of your account size, and you just don't have the money to pay, all the commissions on all these trades, or to like actually afford like the price of the stocks you want to buy, if they unbalance your portfolio, you usually have to, if you have a small account, you might have to avoid big stocks. But once you really start depositing into your account, getting it growing, 5% is a pretty good number. Don't let any single position exceed 5%. Maybe with the one caveat being index funds and ETFs, and things that are already diversified when you buy them. So, the S&P 500 is already diversified. The NASDAQ, if you just buy the NASDAQ composite, or like the NASDAQ 100 in the form of the QQQ, if that's 104 stocks, 103 stocks, depending on how the fund managers see it. And then the NASDAQ composite is, all the stocks on the NASDAQ. So that's diversified. You're not going to have a single stock usually in any of those that are over 5%, except for maybe Apple and the QQQ, like 12%. But those are going to be diversified. And since, you've got professional fund managers that are diversifying their funds, obviously, it works pretty well. Diversify yours too, right? Makes sense. Yeah. Diversification. I wouldn't really say, if you have a bunch of stocks, that you're gonna need, especially like we talked about this on day one, but like if all you have is stocks and you don't have bonds or like CDs, like that's cool. Like that's gonna be your best form of growth, and you're just in it for the long term. So in the long term, stocks are gonna outperform like 99% of those bonds. I'm not saying like if you can get an 8% bond with like a reputable company, like that's great. Take that. That's 6% after inflation. That's a very good return on like a bond, which is pretty much guaranteed. As long as you don't pick a company that goes bankrupt, you'll be okay with that. Sometimes you can find really good bonds that pay, 8%. Like that is right around there. Some really, really big bonds, but most of them are gonna be. There's a lot of different types of bonds, and I'm not gonna really go into different types of bonds. But they're all basically, the main ones are going to be the corporate bonds. And there's different kind of corporate bonds where you can like trade it for equity at some point, or tax exempt bonds, stuff like that. The biggest thing to know with those guys is you can be expecting that 3 to 4 bond return, unless you can find a really good bond from a specific company. We talked about these on day one, but if you can get a return on a bond, 8% bond's great, take it. That is definitely great for diversifying. Another way people diversify besides taking bonds, which they'll usually do when they have like really, their accounts really start to get up there, that's when people will start to say, okay, I'm going to retire soon. If we have a 5-year pullback, I'm not going to be too happy about that. Maybe I want to put some of my wealth into some of these more safe investments, which is totally fine. It's a lot better than having it in cash, obviously. when it's cash, just losing value. You guys know that. Sometimes what another way you can diversify is by investing in foreign markets, so like Japanese stock exchange, European stock exchange, invest in some of the European index funds, European companies. So even if the American economy goes down, we'll see maybe the other economies will go down, maybe they won't. Usually it's pretty random. So if the US economy goes down, that doesn't really mean clear cut that Europe's gonna do great this year. It's usually not associated with each other. And sometimes we do see it, but once you start getting into foreign markets, you're usually going to want to invest in that with mutual funds, like foreign mutual funds with your broker, because then you aren't going to have to go register in a foreign broker, register for foreign funds, and then get into foreign ETFs. Usually you can go through like mutual funds, and they'll be like foreign mutual funds. So when you really start to get up there and you really need this diversification, that's when you can start maybe investing in foreign markets, investing in maybe some higher bonds. Yeah. Sometimes people invest in like, the treasury bonds. Those are like CDs. I mean, those are pretty low returns that we've talked about, guys. I think they are getting up there historically, but, just not the best return, especially compared to inflation. I mean, that's like maybe a % over inflation for 10 or 30 years. Like, just put it in the overall market, and 7% a year, we can get that average return after inflation. That's what we're going for. That's what we're gonna go towards. Yeah, that's diversification, guys. Good job. Don't forget those stop losses. Always try to put in, even if you don't want to look at the stock and look at where the price level is, just thinking in your head, maybe a 10% is what I lose on this stock before I want to get out of it. Something to be careful with about stop losses, though. What's a company that's good for this? Tesla. If we look at maybe the past month of Tesla, I bet you we could get a good little snapshot of this. So, okay, that's pretty good. These are daily candles. Okay, good. So, first of all, Head and Shoulders, if you can see it here, love that setup. You know the short once you see that. I mean, that's the shoulder. That's the second shoulder. But something with, this is Head and Shoulders setup, but we talked about those earlier. I'm not gonna talk about that. What I am gonna talk about is stop losses. So at the end of this, we can see the price starts to go down, and once it goes down, you see a lot of people selling, and a lot of the times that's because they set their stop losses, and their broker says sell, sell, sell once I lose. This went from 370 to like 360, 370 to like 360, and maybe people set their stop losses at like 358, something around there. And if you start to have a market that moves down, suddenly people's stop losses are getting triggered, and you're seeing people sell and sell and sell because they said to their brokers, sell at this stop loss. And that's when you can start to see some fast downward movement, and that's what we saw a lot in like the 08 crash and some of that bad stuff. But this is, I guess maybe 2 months in Tesla. This whole thing's like 3 months best. And we can see 3 times people's stop losses got triggered, they went out. They saw this line here, we saw consolidation here, line right about here, and that's where we hit that maximum on the Head and Shoulder. That's usually where you go short it, and it's just recognizing the patterns. That's a Head and Shoulder, and you see this line right here because there was a lot of stagging around there. And yeah, maybe a little, like right at the bottom of this candle, you guys can't see it, but just draw your support and resistance lines, and those are where you're going to want to sell and buy, blah, blah, blah. But we see on this downtrend, it starts to go down, and then people start selling, people are panicking, and a lot of that panic is just stop losses going off. It's like a big part of trading is trading smart, but also trading off of facts and not really as much off emotion. I know it's a little tough, but the goal in the end, you are dealing with real money. Like paper trading is a way you can prepare for the stock market, but I just don't like it because you don't have the real emotion of trading. And when you're doing this stuff, and you lose money on a trade like this, like you're gonna remember that and you're gonna think about what went wrong. Like on a paper trade, it's just not the same psychological connection. You aren't actually losing it. So this is a little tangent about paper trading, which is trading fake money to practice. I really wouldn't recommend it, guys. Just like decrease your share size, right? If you're trying to practice and you're not 100% confident, just buy one share and trade it like you would if you had 10 shares. Or trade it if you just have one share. Just trade it like you normally would. Just decrease your order size, so you just buy like one share or a very small amount of shares. Tesla's an expensive stock, but these $10 stocks, $15 and $20 stocks, you can really start to practice on them by just buying very small amount of shares. And once you get more comfortable, gradually increase your share size. If you're active trading, this is for active trading, not long term, just put it in for retirement, for active trading, for practicing for that. And usually with active trading, diversification is a little bit different. So maybe, for example, you have like 10 grand in a retirement account and you've got that, you're just trying to make your market returns on that. And then you have like 2 grand in a day trading fund or a swing trading fund, something like that. And we're just going to ignore the PD2 rule, which we talked about a while ago. I think it's like day 1. PD2 rule, you can't make more than 3 intraday trades if your account's under 25 grand. But just ignoring the PD2 rule. Let's say you put your 10 grand into like 3 ETFs, or put it all in the QQQs or something, or
Miss Massengale, please dial 2402. Miss Massengale, 2402.
a diversified index fund, and then you start to day trade with your 2 grand. Day trading position size is a little bit different because when you diversify, or when you get into a position, what you're doing is you're saying, how much of my account, if I start here, if you risk all of your money on a trade and lose 10%, you're going like to here, right? If you risk about a quarter of your day trading fund, then you'll just be here on your loss. Similarly, if you risk everything and you make the game, you can see more money with the 4 times the money put in, but also more risk, so you're gonna have more volatility. And this is why I focus on percent gains, because the percent gain for both of these is the same, but the amount of money you make is different because of your position size. So when you're day trading, guys, start off with small positions, because like just theoretically, if you make like double your money, we'll erase these dots and say you make double your money on a trade, you double your money on a trade, you double your money on a trade. 2 grand turn to 4, turn to 8, turn to 16. Then your next trade you lose half. Back to 4 grand. Then your next trade you lose half of it. You're back to where you started. I mean, now a way we can minimize that risk is we'll put in on a $2,000 day trading fund, we'll just do a $500 trade. Or like a quarter position, something like that. So maybe a half position if you really like it. Something in between's never bad. So you can take a little, obviously that's bigger than our 5-7%, because that 5-7% is for long term. But when you see, quick trades, quick setups, charts you're trading, that's when you can take a little bit bigger positions, because those are active trades. And you're not usually hold a day trade or a swing trade for the next 10 years. That's different with long-term stocks, obviously. We got a couple minutes left. Diversifying day trading is usually you're gonna have maybe 1, 2, 3, 4 at the most, I mean, it's tough usually to start out. Usually you'll start out with one position at a time on a day trade. And then once you get more comfortable, maybe if you have more screens, that really helps. If you can have more charts up at the same time, and you can follow 2 stocks, 2 tickers, you can get comfortable with that. You can start to trade more stocks at the same time. So maybe you trade 3 stocks at the same time, $500 in each of them. Remember though, you're looking for quality, not quantity. So it's better to just start it slow and make a really good trade on 1 stock than to just make like trades on 3 stocks and maybe lose money on them. Because if you lose money on 3 stocks and then you're trying to move on real quick before everything dies down around noon, you're starting at 9:30, you're not going to really have a lot of time to think about, okay, what went wrong. But if you have 1 position and it's a false breakout or something, and you can really be able to look at that better and say, dang, I went wrong. But you had it, so it wasn't too much your portfolio, right? So you were okay with like a 10-20% loss on whatever that was, because you had it diversified. It's not like you just lost 10% of your entire portfolio. You lost 10%, maybe of a quarter of it, or you made 10% of a quarter, which is great. The upside's what we trade for, but you got to be prepared for the downside, because there's always a winner and a loser on every trade. The people that bought up here, not very happy. But the people who shorted up there, they're in the money, right? So that's why you set stop losses, right? Like, we're right here. Like, no one knows for sure if it's gonna go up and down. So stop losses, diversification. That's just about all the time we have for today, guys. Just keep in mind, keep your funds diversified so that in the long term, everything will, won't have too big of an impact on your account if one company does poorly, or 5 out of 100 companies do poorly, or 20 out of 100. As long as you have more people doing well than not, then you'll be good. And day trading, just manage your risk. That's a lot more active. That's a lot more, you're thinking about it, you're trading it off the charts. You know what's going on with that. And you're just gonna trade it as if you are risking what you're willing to risk on it. So however much you like to set up, however confident you are in it. Thanks guys, I'll see you tomorrow.